I think Bitcoin has two core elements to help people understand it. One is the digital gold, or a store of value, a safe haven, essentially. But what's weird about this safe haven, it has a volatility of like 65%. And that's because it has another attribute. It's basically a call option on the future. And so it has these two attributes, which are really interesting. It offsets, let's say, the largesse of central banks and maybe other certain types of uncertainties. But it also has this ability to price in with an exponential upside the future of the financial system that everybody's busy building out on blockchain technology.
And do you think that investors are wise when playing around with that as their goal, using it as a safe haven in your opinion?
I do. I look at, for example, the simple way of looking at the world we live in is the expansion of central bank balance sheets around the world and what that could mean for debasement. And you can actually look at all assets using the denominator of that. So things like the S&P has basically offset the fall in the central bank balance sheet since 2008. 2008 was a big remarking. And that's true of gold and others. What Bitcoin has done is actually offset it, and more so. So it's one of the only assets in the world that's actually outperformed the rise of the central bank balance sheets, whether that's the Fed balance sheet or the G4 central bank balance sheets overall. So yeah, it's worked astonishingly well for that purpose, and also for the purposes of the rise of the new technology. So it's definitely been highly accretive to most people.
And Sheila, you've kind of been working on this from more of a high level over at the World Economic Forum, viewing it from all perspectives. Obviously, one of the most common questions with Bitcoin and other cryptocurrencies is, are we in a bubble? Are we going to see that bubble burst again with the price having topped 60,000 last month? Do you think that's where we are now? How risky is all of this for investors?
Well, there's always risk, but I would say that, I don't know what kind of asset is performed in this manner that people would still attribute a tremendous amount of risk to. I mean, just look at where Bitcoin was and where it's been and what the trend has been. It's not to say there isn't going to be more expected volatility in the asset and ups and downs and this and that. And there's always the question of how people are going to be gaming the market or trying to time things for some of these dips. But no, we don't feel that crypto as a general asset class is risky any more than any other sort of more, let's call it fringe type of investment, right? So, and certainly our guidance, without giving investment advice, has been for a while that if you're looking for diversification, there are all kinds of things people could do that are far riskier than an investment in crypto at this point in time.
And on that as well, Sheila, I mean, we're looking at the different kinds of people that are getting involved in cryptocurrencies now, and one of those, at least in the most recent discourses, has been institutional investors. How do you see institutional investors working crypto into their portfolios, and how concerned should they be about volatility, and how should that affect their decision making?
Well, I think the dirty secret is that a lot of institutional investors were holding on to a little piece of this for quite some time, just in some ways almost because of a why not sort of approach. And I think a lot of them are just becoming more public about it. And of course, some are just really going all in almost in how they're thinking about it. But it's not like they haven't been paying attention or they've been, this is brand new. I think we certainly expect to see more institutions go more and more into crypto as a general asset class and into Bitcoin specifically. I think that also includes big university endowments, for many of which have been holding Bitcoin specifically for quite some time, sovereign wealth funds, like all these different family offices, right? I think all these different kinds of investors are starting to say, look, we want to have a piece of this, the way people used to back in the day think about international stocks or whatnot. We want to have a piece of this because we are well diversified already and we can accommodate whatever risk this might entail, and doing a risk analysis as it pertains to them specifically.
And Raoul, does that correlate with what you're seeing too?
Yes, I mean, I spend a lot of my time speaking to large institutions, everybody from sovereign wealth funds to family offices to the world's largest pension plans, asset management firms, and everybody's either getting involved, is involved, or in the due diligence process of doing it. I think you can't avoid the fact that it's the best performing asset class in all recorded history already. And it is the best performing asset over any period of time pretty much you look at. And it's a $2 trillion asset class when you look at digital currencies overall. You can't not look at it. And then when you look at the portfolio effects of actually putting in a portfolio, even if you create your own bucket for it, or you top slice it across all of your assets, the accretiveness of its risk reward profile and its volatility actually reduces the volatility of an overall portfolio. So for institutional investors, it's like one of these holy grail instruments that skewed to the upside, lowers your overall volatility, even though it's volatile itself.
And where do we think regulation is going to come in there? We've had some really big players recently, like Amundi, the asset manager, coming out and saying as soon as regulation hits the sector, the price is going to drop, especially for currencies like Bitcoin that have reached such highs in recent weeks. Sheila, coming to you on this, what do you think of that? Do you think that we're going to see a big price correction once regulation hits the market?
Well, I think the important thing to remember about Bitcoin specifically is that it really is an a-jurisdictional asset. So it is not controlled by any particular jurisdiction. And therefore, if it's pushed out of one country, let's say it becomes illegal to hold it or trade it or whatever in a country, then it's just going to kind of shift holdings to another place potentially. So I think you have to look at this globally in order to understand what the effects might be. Now, that being said, there are countries that are moving in the direction of potential things like bans, or at least talking about that. They're looking to some cases compete, which is an interesting concept because whatever a central bank, for example, might issue be a very different thing than what Bitcoin specifically is. But nevertheless, this is a conversation that's ongoing. So I do think there'll be regulation. I personally think that where the regulation will come into play is more on things like taxation, the taxation of the gains on this asset, or is an example of where I expect to see a tremendous amount of activity. And that seems like very rational activity by governments. Also, who is allowed to invest in what? Consumer protection kinds of laws, accredited investments, these kinds of things, I think we're going to see more of around the world. But the bans and things people talk about in terms of then it's just going to crash the whole market, it doesn't resonate unless you suddenly had a globally coordinated sort of movement like that, which seems relatively unlikely.
Yeah, and on that topic as well, pivoting slightly, we had Tom Jessup on earlier from Fidelity, which recently joined with some other companies to launch a crypto council to kind of lobby regulators on these topics. And Sheila, you've previously said that you've got some pretty nuanced views on this area. What do you think this group could achieve?
Well, I think there's been quite a lot of effort by various organizations in coalition to lobby. I think we saw tremendous activity when FinCEN, when notice came out here in the United States in December. You saw a tremendous outpouring of commentary from the community, organized by a number of groups out of Washington Association and others. What I think is really interesting is what we're seeing is the consolidation of this group as the new power players, in a sense, in the space. Now, not to anoint anyone, because there are new players entering the market all the time. And I think that we are still in the very early days of the companies being built in this space. But when you think about the new fangs and where that power might lie, it's hard not to give a nod, at least, to movements or initiatives like this. I think that's a double-edged sword. I think it's good and bad. I think the more that you see consolidation and coordination among some of the major players in terms of holdings, the more attention you're going to draw to the fact that there is a tremendous amount of power, both financially and otherwise, that's being collected into some of these systems, not unlike, FANG or BAT or whatnot. So I think I exercise, as usual, caution's the watchword, and we'll have to sort of see how the whole thing plays out.
And then I guess the other side of this is also for retail investors, what they can start to expect in the next few months or years, and how they should really play with crypto in their portfolios. And Raoul, this is somewhere where you've got a lot of experience. Do you think that retail investors should consider direct holdings, buying and selling the tokens themselves? Or should they think about gaining exposure through crypto-focused exposure baskets, or even in future a Bitcoin ETF when that eventually appears?
Yeah, I'm a bit of an outlier in the crypto world because most people in the crypto world don't like regulation. And I think that regulation will attract more capital and more security for everybody. And I'm in favor overall, as long as it's a light touch regulation that allows people to build the ecosystem around it. For retail, it's the same thing. As Sheila mentioned, there's a lot of products out there that have a lot of risk, and I don't think that risk is understood properly, and I think that needs to be managed. There's no problem with people taking risk, and I think they should be allowed to, but they should know what risk they're running. I think all of that rolls out, and I think what is good is there is a suite of risks you can take in terms of product allocations. So whether you want to have an ETF, or you want to have exposure to Coinbase at one end, or you want to own tokens in your own wallet stored in a cold storage device, you can choose any area of the risk curve that you want. You can store it, you can trust a counterparty to store the coins for you as well. That's great. Choice is a good thing. There needs to be guidelines to allow people to understand what choices they're making. And I think that's not clear yet for people. I think the space generally is confused by the amount of choice out there. And I think that will all come. And I think regulation is only a good thing because it will give people the confidence, particularly people who have a fiduciary duty, RIAs, asset management firms, pension plans, trustees, to allocate capital into this new exciting asset class.
Yeah, and as we wait for more audience questions to come in on that, we can always think about other areas of this too. I mean, it's not just crypto that you can put in your portfolio, right? It's also blockchain and the related technologies around it. Sheila, where do you think blockchain fits into all of this? And could investing in the technology itself, the protocols underlying cryptocurrencies, be a good way to get in the sector without actually having to be hit by that price volatility?
Well, it's an interesting question because, of course, the protocol is connected very much in many cases to a coin. And so what you're actually investing in is sort of highly correlated. I think, though, that well, I'll just express my personal hope is that, we'll stop talking about blockchain per se, because it becomes a sort of inevitable part of a tech stack and that it's used, I think, in a variety of contexts. Now, I think that's not going to happen until we're a little further along in the maturation of the technology. There are things happening and there are a variety of new protocols coming up that are, for example, faster, less energy intensive, et cetera. These are things that matter to some. And so I do think we're going to see more of a ubiquitous use of blockchain as, again, part of a tech stack. And I think that it will move it to being something that's kind of like the internet. So when you imagine investing in the internet, well, what does that mean to you? And would you have done that in the early days? Similarly, you could think about investment in technology. I think there's an analog to be made there. So again, everyone has to do their own risk assessment. I couldn't agree more with exactly what Raoul said, that there is a spectrum of risk. And so it's important to educate yourself about where you want to fall on that spectrum and what kind of risk you're willing to take and what kind of return you're expecting. So this is another example of something that you could choose to do.
Yeah, and Raoul, just to jump in on that as well, you've got experience with kind of companies all over the spectrum, but with the Coinbase IPO coming up soon, investors are going to be thinking about, is that one way that they can get into this sector without having to be hit by the volatility that it is markers of Bitcoin and other currencies? Is that Coinbase IPO going to be a really good way for investors to think about getting involved in exchanges, for example, rather than blockchain itself?
Yes, and I think you're already seeing, I think Bitcoin has stalled somewhat as institutions have put in their allocations to the Coinbase IPO. But don't forget, volatility is a feature. It's a feature that drives the risk reward. So without that volatility, you can't have compounded annual returns of 230%. So volatility is your friend in this occasion. Now, I don't think the exchange, so I doubt that Coinbase will trade less volatile than the underlying basket of digital assets that it represents. So these are all volatile things, but the volatility is highly skewed to the upside. Doesn't mean you don't get sharp downside shocks and you can't see big moves, but over time, obviously with an asset that's appreciated, 99 million % since 2010 or 2009, you see that skew, but you've got a lot of volatility, but it is the feature. It's what you want in a risk-seeking asset.
Yeah, and then also on that, I mean, if we jump that far ahead into the future, what do we think about how can investors move crypto into their portfolio when the volatility ends? Hopefully, at least, maybe not end, but it also starts to tone down at some point. How do we think retailers can really gain in that sector when the volatility isn't giving them that 230% markup?
Well, much like all financial markets, you can invest in the S&P or you can invest in Mongolian equities. It's called a risk curve. So the token-based markets, where you have different protocols, different products, they're all there and they all have different risks. So right now you can invest in a very early stage DeFi project that's basically a mark-to-market, real-time mark-to-market VC project. It may go bust, it may succeed. You could make 3,000 times your money, or you may lose all of it. And that function will always be there because there's so much innovation in this space. There's going to be tremendous amounts of new products, new opportunities, new projects all coming to market. So I think even as Bitcoin volatility over time diminishes, we'll still have a very big risk curve that generates a lot of alpha for a lot of people.
I think that's so important to note, because there is this sense, I think, from some that, oh, I've already missed the boat, and like, this is what there is, and I didn't invest in an exchange, and now, we are at the beginning of the creation of an entirely new market that we can't even see yet. You look at NFTs, they're certainly frothy right now. There's a core there that is going to maintain and be real. Social on blockchain, crypto social has just started. We're just starting to see some of that. And right now it's still in the kind of comedy phase, right? Like if NFTs are the sort of new phase of crypto kitties, then, BitCloud is probably a couple of years from now, you're going to see whatever that turns into. So there's so much more that's going to arise in this space. And it's important to recognize that, and recognize that even though we are a decade out, we're still really early in terms of the different kinds of opportunities that are going to be presenting themselves over the course of the next 3 to 5 to 10 years.
But a lot of investors now are thinking about how can they gain on these opportunities while also thinking about their responsibilities as investors. ESG, environmental concerns are increasingly becoming more important for investors. And crypto is somewhere that really struggles to fit in with that, because obviously there's a lot of carbon consumption involved in mining tokens like Bitcoin. Sheila, what are you seeing on that as somebody at the top level?
Yeah, well, the forum is really interested in this. And actually, we're embarking upon a new initiative that's going to be looking specifically at crypto and ESG and how we think about metrics around that, where existing ESG metrics make sense, where they don't, where we need kind of a new model of thinking about this. But, the standard response to criticism around environmental concerns is to say, well, what are you comparing it against and how are you contextualizing it? And I actually think that is fair and important, but it tends to be delivered a bit flippantly. But I think it's actually really important to understand right now. Let's look at Bitcoin specifically. Bitcoin is running in parallel to the existing financial system. So all of these claims about, if you look at the existing financial system, it takes this much energy to, print and then transport and whatnot, cash. Well, we're still doing all of that. And now we're also doing Bitcoin, right? But over time, we are going to see movement across, I think, and new generations of, I call them crypto natives. We have digital natives. It's a very common term now. There's a generation being born of crypto natives who will have expectations around how the agency they have around their data, the empowerment they have in the financial system. Crypto related things, whether it's Bitcoin or not, is really not for me to say. Something like that. And the crypto kind of concept is going to become more and more powerful and expected, I think, as we move into this next generation. And you're seeing that as we see a little bit of erosion of some of the power held by these current generation of internet companies that do a lot of things around data control, for example. So as we get into the new markets that I was talking about around social and things like that, you're going to see, as you see AR coming into play with some of these things, you're going to see a lot of different opportunities open up. And I think it's important to understand that the environmental concerns have been top of mind for most people, I would say, in this space for a very long time. So whether it's ETH2, which in the Ethereum space, whether it's miners transitioning to clean energy, renewable energy, looking for remote locations where they can actually serve as a market creator in terms of generating things like solar, hydro, or whatever it might be, wind. I think there's a lot happening. So I would encourage people whose knee-jerk response is to immediately be negative about this, to do a little more investigation and to know that there are some initiatives coming up that are addressing this problem head on. We shouldn't be flip or naive about the fact that there is a lot of energy being consumed here, but there are solutions to some of these things. And we just have to be a little bit more thoughtful and creative in our dialogue about these topics.
And on that as well, we've had some great questions coming in from our audience. Michael has asked how we can explain how we value a cryptocurrency. Obviously, we've talked a little bit about Bitcoin as digital gold, but with these other things coming in, blockchain, ESG, data, AI, what value Bitcoin can provide and cryptocurrencies can provide is always changing. Raoul, do you have any comment on that?
So there's a standard way that most of the industry has caught on to valuing Bitcoin, which is called stock to flow, which is essentially the supply versus the demand of the asset over time. But I think the more useful one is many people are more familiar with social networks, and you value social networks using something called Metcalfe's law. You find that actually it's a very, very good way of valuing all cryptocurrencies regardless. It works very well. They're very consistent, and you can pretty much map them over things like the growth of Facebook, the growth of phone networks, and the value that those things accrete. Now, obviously, this is a network of money, so it's probably valued much more than any of these, probably even added together. But so there are ways of valuing it. We don't use cash flow valuations because this is a very different thing. It's an adoption of a technology that has a number of use cases, of which most of them are unknown to us. So, it's a very interesting thing, but it's basically the number of people who join the network, whether it's people holding wallets or the number of people developing onto that, create this ecosystem that has more and more value over time.
But that in itself is also still up for debate, how we value a cryptocurrency. And Sheila, that's something you're paying attention to, right? Is how we ascribe value and what determines the price of a Bitcoin, for example. And Julianne has asked, globally, what currently are you seeing in terms of countries that tolerate bit currencies, and which countries are really repudiating it at all, if any?
Well, I without getting specific, I think the obvious one that's kind of on the table is India. India has been flirting with the idea of an outright ban for a little while here. It goes back and forth day to day, depending on who you speak with, if that's actually going to happen. And there are other jurisdictions that are looking at that. But I think what's important to recognize is that any jurisdiction at this point that we're speaking to, at least, is looking to do something like, ban's a very strong word, but, mitigate the ability, let's say, of an individual retail investor to basically invest, right? Let's call it that. It's often because they are looking at something else in the space. They have a concept that, a CBDC, for example, or some kind of stable coin or something else might be what they want to support more than Bitcoin or more pure, let's call it crypto. And so I think it's not a repudiation of the space. It's more a desire to pause things almost while they harness some of this value as a government or whatnot and try to adopt it themselves. And so I think that's really where the motivation is coming from. It's less fear-based than what we saw in kind of in the 2017 to 2018 period, where you saw a lot of kind of fear response in some of the regulation. I don't see a lot of that now. There's pretty much a globally understood acceptance that this is not coming, it's here, and we all need to be reckoning on what to do with that. Some of this is also just cultural and people kind of wanting to ensure that there isn't this sort of takeover of some kind happening that they don't fully understand yet. So it really varies widely. And when you consider the globe, you can see still a lot of the innovation in this space by governments and banks is happening in smaller or frontier economies, which I think is unsurprising and very exciting.
Very interesting. Well, that's all we've got time for today. So thank you, Raoul and Sheila, for joining us.